The second approach that people talk to me about all the time is a HELOC.
Right.
Home equity line of credit.
This is Las Vegas Real Estate Now with local real estate expert Harvey Blankfeld.
This is a very popular option right now, especially because it allows you to leave your existing low interest rate first mortgage in place and get you a second mortgage that gets you the cash potentially that you want, or that line of credit that you want. There are a number of things to know about this just in the headlines, which is to say, the interest rates on HELOCs are going to be higher than normal mortgages. You think the normal 30-year fixed mortgage is a high interest rate? Well, you're going to go up another notch, right?
A lot.
They are adjustable interest rate mortgages,
Right.
most typically. They will follow the prime rate, whether that goes up or down. They're going to follow that, and they have a adjustability feature that I really want to draw people's attention to, which is you'll have a payment, an interest-only payment for a certain period of time, whether it be 5 years or 10 years is very common. But then after that, that loan changes and it becomes a 15 or a 20-year fixed payment. I'm
Right.
sorry, a principal and interest payment, not a fixed payment, but a principal and interest payment.
Fully amortized.
Fully amortized to get paid off to zero in 20 years. So that payment jumps significantly.
The other option is to do like a fixed rate second, or let's say I own the home outright and I want to borrow money against the home. I can do that too, right?
Sure. Yep. You would get a brand new fixed rate first mortgage. Well, not necessarily fixed rate. You could get an adjustable. You could get any other type of product. But yeah, you get a cash out refinance mortgage that becomes the first mortgage on the house in that case, and all the standard sort of stuff applies. You're just not paying off a mortgage
Right.
as part of the refinance. The fixed rate second mortgages is a conversation out there. Actually, and this is a brand new thing that's getting ready to come out. Freddie Mac is actually getting ready to launch that product. They're
Okay.
going to put out a fixed rate second mortgage product to create sort of a what's the right way to say it? I don't know, a default buyer of those second mortgages so that people can access the equity in the home without messing with those really cheap first mortgages.
Okay.
Right. So they're providing their solution. And so instead of the mega bank offering you that fixed rate second mortgage using their own sort of proprietary rules and their own money, Freddie Mac can become a funding source for those products. And, all of us mortgage lenders could potentially offer it out.
Nice.
So that's an interesting. But so with those, you need to, just be aware of, you can get the money out. Much more common. They will have a fixed interest rate where you'll pay, I don't know, 10.5, whatever it is,
Right.
On that, and that would last 15 years or
Okay.
20 years, depending on the term. There's a little bit all over the place. Those are really good for the stability aspect,
Right.
because you know what your monthly payment's going to be. They don't have the ability to draw the money out and pay it back and things like this.
Right.
Here's your lump sum of money and
Yeah,
you live your
HELOC's
life.
almost like a credit card. To a certain
HELOC
extent.
is very much like a credit card.
Yeah.
It's a line of credit.
It's a line of credit. Yeah, so you can pull money out, put it back, and you can just keep using it over and over
Yeah,
again.
you know what? That does bring up kind of a cautionary note there. What we saw during the Great Recession is all those HELOCs, many of them got shut down.
Yeah.
So the banks and the lender do have the power to say, yeah, you're supposed to be able to draw on this HELOC and use it like a credit card for 5 more years, but we're shutting it off.
Yeah.
And you can no longer draw on it. All you can do is pay towards it. So they retain that power, and that's another thing you have to keep your eyes open to in using those products. The fixed rate second is fine, but you just have to be ready for the idea that if you're using that fixed rate second to pay off debts, that, okay, now you've got this new big payment for the second mortgage.
Right.
If you rerun up the debts, you're going to be that much tougher
Right.
in a tougher spot because your overall bills are just going to be that much higher.
Yeah.